The Korean won just crossed 15.20 per dollar, the weakest level since the Asian financial crisis of the late 1990s. According to reporting out of Seoul this morning, that breach happened today, June 21, 2026. North Korea's escalatory response to the Korea-EU joint statement is adding a geopolitical risk premium, pushing the won lower still. Here is why that matters. A weaker won sounds like a tailwind for Korean exporters. Dollar revenues convert into more won at home. But Korea's flagship sectors, semiconductors, autos, petrochemicals, import their raw materials in dollars, crude oil, silicon wafers, industrial chemicals. When the won weakens, those input costs spike in local currency terms, compressing gross margins even as top-line revenues look healthy. Samsung Electronics and SK Hynix are the names to watch. Both are approaching their first-half earnings disclosures. Korean conglomerates have historically carried limited foreign exchange hedging relative to Taiwanese or Japanese peers, so the margin hit is more direct and less buffered. If Samsung and SK Hynix margins deteriorate, that ripples into global memory pricing and touches every US chipmaker and tech hardware name downstream. If you hold global semiconductor ETFs, Korean ADRs, or any fund with heavy emerging market Asia exposure, this is the moment to audit that foreign exchange risk. At 15.21 to the dollar, Korea's currency is flashing a margin warning that semiconductor and emerging market investors cannot afford to ignore this earnings season.